Hey guys, welcome back. Hope you all are doing well. In this video, we will discuss Indian banking system. We will cover the basic meaning and definition of bank as per Banking Regulation Act, and the primary functions of bank, the history of Indian banking system, different type of banks, and important act related to banking system. Okay, so this is a fundamental video based on Indian banking structure, and we will go through all these facts, which is quite important toward the understanding of bank. Okay, whenever we talk about Indian banking system, so you may face the objective questions in your written examination as well as in interview, like how bank generally work, what is credit creation, or what is the primary products of bank. So you will get all answers after watching this particular video. Okay, the only request is please do like and share this video with your friends so other can also watch, and if you are new, please do subscribe. So first question is, what is bank? So bank, as you know, these are financial institutions, okay, and they generally borrow money from the depositors, those who have surplus fund, and they lend that particular money in form of loans. Okay, so we have different type of loans, so the primary function of bank is basically borrowing for the purpose of lending. Okay, and they borrow money at a lower rate of interest and they lend the same amount at a higher rate of interest. Okay, so this borrowing for the purpose of lending, or the difference between interest rate of borrowing and lending, that is the profit of bank, and even the amount which generally borrowed from the customers, which is lended to the other customers, so that is also known as the credit creation in the market. Okay, banking is generally defined under Section 5 of Banking Regulation Act 1949. Please do remember this one. So many time examiner they generally ask question based on this particular section. Okay, so it is defined under Section 5B of Banking Regulation Act. So banking means accepting for the purpose of lending. So there is two things. One is borrowing or accepting of deposit in the form of CASA and RAFA, so current account, saving account, fixed deposit, recurring deposit, and lending in the form of loans. Okay, so basically we can say accepted for the purpose of lending or investment of deposit of money from the public, repayable on demand, or otherwise and withdrawable by a check, draft, order, or otherwise like other tools. Okay, so the primary function of bank is, or the meaning which generally define the meaning of bank which generally define the overall functions of bank. So they generally borrow money from the public and they lend that particular money to the public. Okay, so let's say there is a bank who borrow 100 crore rupees from the public, so they have to maintain some reserve in the form of CRR and SLR, and then after that one they lend that particular money to the customers. Okay, so lending job in the form of loans and advances. So they lend this particular money to the public at a high rate of interest. Okay, let's say they borrow this money at the rate of on an average 5%. They landed this one on an average 8%. So the difference of 3% is the profit of that particular bank. Okay, so bank is a lawful organization. It is a law bounding organization because it is the working of bank is generally defined under RBI 1934, and the registration of bank that generally comes under Banking Regulation Act 1949. Okay, so I hope you guys heard about the scheduled bank or non-scheduled bank. So scheduled banks, those who generally follow or fulfill the guidelines of second schedule of RBI Act 1934. Okay, so it is a lawful organization because there are some laws. They generally act as per the laws. So like RBI Act 1934, Banking Regulation Act 1949, or even other one as well. Okay, so and they are registered under Companies Act 2013. So they accept deposit in the form of CASA and RAFA, saving account, current account, fixed deposit, recurring deposit, and allow withdrawal on demand. Okay, it provide loans The second part is lending. So they provide loans like retail loan, wholesale loan, corporate loans, okay, to the individuals and business entities. So the difference between these two, let's say there is a bank who borrow money on an average of 5% and they landed this particular amount on an average of, let's say, 8%. Okay, so the difference between these two is 3%, which is the profit of this particular bank. And bank, they generally, let's say if you have surplus money, so you can deposit that particular amount with the bank, and then bank, they do credit creation in the market. They generally lend that particular amount in the market, so that is generally part of credit creation of banks. Okay, so basically we can say bank that generally deals between two things. First one is borrowing. So borrowing for the purpose of lending. So this is the primary function of bank. Okay. So borrowing for the for the purpose of lending. This is the meaning of bank as per section 5 of 5B of RBI Act 1934. So they generally borrow money in the form of CASA and RAFA. So current account, saving account, and fixed deposit and recurring deposit. Okay. So RAFA stand for recurring deposit account and fixed deposit account. Okay. So they generally borrow money in the form of CASA and RAFA, and they lend this particular money in the form of loans. Okay. So they generally give loan to customers, to individual, to business houses, or to government and all. And this activity is also known as a credit creation done by banks, because let's say if they borrow 100 crore rupees, then out of this they have to maintain CRR and SLR. So remaining amount they generally lend to the customers, and they are creating they generally giving loan. So that means they are creating some credit in the credit flow in the market as well. Okay, so loans, we have different type of loan, like loan to individual, like retail loan, that is known as car loan, home loan, education loan. So corporate houses or a wholesale loan, so that is generally part of lending side. So in this video we will discuss these particular thing in detail. So now if you talk about the role of bank, so they generally work as an intermediary between borrowers and lenders. Okay, so lenders, who is the lender for the bank? So this is a liability product. Okay, so lenders, these are basically lenders to the bank. So those who generally lending their money with bank. Okay, so this is the liability product of bank, because this money belongs to someone else. Okay, and loans, where bank, these are generally borrowers. These are generally borrowers who generally borrow money from the bank. So these are asset products. So bank, they generally generate income from these particular asset. Okay, so bank that generally working as a intermediary between borrower and lender. So lender, deposit fund with bank. So liability product, liability for the bank. And borrowers, those who borrow money from banks, these are like in the form of loans. So these are generally known as asset products. So these are the assets for bank. Okay, assets is basically from these particular lending. Okay, if bank is giving loan to any customer, let's say you borrow education loan from bank, so you have to pay certain rate of interest to the bank. So from that particular asset, bank is generating some income. So that's why that is generally known as asset product of bank. Okay, hope this is clear. Now, if you see the broader classification of asset and liability, so assets for bank, these are loan given by banks, loan and advances given by bank. So it can be like any loan, like home loan, car loan, education, personal, business, or cash credit or overdraft, which is generally part of the advances, or discounting of bills. So these are the part of your asset side. Okay, and liabilities, if you see the bank balance sheet. Okay, so deposits which are done by customers with banks, so these are the liability product. Okay, so we have two type of liability. One is demand liability, CASA deposit, they generally known as demand deposit, because they can be demanded by customer anytime. Okay, that's why they generally known as demand deposit. So current account and saving account, CASA, so these are generally part of demand deposit. And time and term deposit, So these are RAFA deposit, recurring deposit account, and fixed deposit account, because they like customer, they generally deposit these they generally open these particular accounts with bank for a fixed time duration. Okay, let's say you did a FD with bank, fixed deposit with bank with 5 lakh rupees at the rate of 7% per annum. Okay, and it was for 10 years. So this amount is bank will hold that particular money for 10 years. So here we have this one. In case of saving account and current account, these are CASA deposit. So customer can demand this particular money anytime. Let's say in your account, in your saving account, you have 10 lakh rupees. So whenever you require that particular money, you will request for the withdrawal. Okay, and bank have to maintain that particular fund. Okay, so these can be demanded anytime by the customer, and this is for a fixed time duration. Okay, so please do remember this one: demand deposit and term deposit as well. Okay, we will discuss these particular thing in detail as well. So as of now, please do remember this thing. So basically, bank that generally work as an intermediary. That meaning of bank is borrowing for the purpose of lending. They generally borrow money from the customer and they lend that particular amount to the customers. Okay, so in between of this borrowing and lending, they have a margin. So that margin is basically profit. Okay, and bank, they generally borrow money from customer, so they lend that amount to the customer. So that is also known as credit creation after the deposit of reserve ratios. Okay, CRR and SLR. Okay, so hope you get this particular thing clearly. Now let's move to the basic historical background of Indian banking system. So this is a basic video about Indian banking structure. So you need a clarity about banking system, so you can easily understand the remaining concepts as well. Okay, so what is CASA deposit, what is current account, what is saving account. So I already discussed these particular one in our previous videos. Even in this video as well, I'll give you an idea. Okay, when we'll come to the functions of bank, let's talk about the historical background. So sometime I hope you guys read about the first bank in India, or the first bank which was managed by Indians with limited liability, or the bank which is managed by Indians with full liability, or first commercial bank in India. Okay, so we have different histories. So you can further classify this particular history among three parts. One is pre-independence, okay, till 1947. Second phase is that is also known as nationalization phase, 1947 to 1990. Then post 1990, that is called modern era. Okay, after this new economic reforms or LPG policy, liberalization or privatization and globalization model. So that after 1990, there is a drastic change in Indian banking system as well. So that is, from that onward, it is generally known as the modern era of Indian banking system. So basically, government start giving license to private bank or foreign banks and also that's why that is the part of modern banking. Okay, so first one, if you talk about the pre-independence, okay, so till 1947, 1970 to 1947. Why so? Because the first bank in India was established in 1970, that was Bank of Hindustan. Okay, and it was established by Alexander and Company. Okay, so this is a historical fact. You have to remember these particular things. So the best way is, like, after watching, you can prepare your notes or you can practice a question based on these particular concepts, so you will easily remember these particular facts. So Bank of Hindustan was the first bank in India. It was established in 1770, and it worked till 1832. Okay, so due to bad management, it was closed. It was established by Alexander and Company. Okay, so it was established in Calcutta that time, the then Calcutta, now it is known as Kolkata. So this bank failed to work and ceased operation in 1932. So first bank in India was Bank of Hindustan, which was established in 1770. Then after this, after Bank of Hindustan, so General Bank of India was established in 1786. It worked till 1791. And Awadh Commercial Bank, it was established in 1881 and it worked till 1958. Okay, Awadh Commercial Bank, there is a condition for Awadh Commercial Bank. So please do remember this particular note. Okay, So it was the first commercial bank in India to have limited liability and entirely Indian board of directors. So this was the first bank which was opened by Indians with limited liability. Now there is a difference between limited liability and full liability. Like Punjab National Bank was the first bank which is managed and owned by Indians with full liability, and Awadh Commercial Bank was the first bank which is managed and owned by Indians with limited liability. Now, what is the difference between limited liability and full liability? So, in case of Awadh Commercial Bank, this was run by Indians, but the credit guarantee is generally issued by East India Company, or you can say Britishers. Because if you see that time in 1881, so Britishers was ruling us, and investors or depositors, they have more faith on Britishers as compared to Indians. Okay, so this was the first bank which is entirely managed by Indians. Okay, but the credit guarantee is generally taken by East India Company. So that's why this basic difference. Okay, so after this, like in 18 1894, Punjab National Bank was established in Lahore. It was initiated by or established by Lala Lajpat Rai. Okay, it was the first bank which is managed and owned by Indians with full liability. Okay, and the other bank also. So now we have Presidency Bank. Three Presidency Bank in India. First one is Bank of Bengal. So Presidency Bank, like if you study Indian demographic in 1800, okay, so 1809 to 9 till 1900. So India was basically Britishers, they generally divide India among three parts. Okay, so first they in different areas to cater banking services, they created some banks. So these are generally known as Presidency Bank. So first one was Bank of Bengal. It was established in 1809. Okay, 1809. Second one was Bank of Bombay, 1840, and third one was Bank of Madras in 1843. So these three were the Presidency Bank, which are generally catering the banking services throughout the India at that time. Okay. Later on, these three merged, and we created a single entity in 1921 that is generally known as Imperial Bank. And later on, Imperial Bank was taken over by RBI in 1955, and it was renamed as State Bank of India. Okay. So bank, whenever we talk about Presidency Bank, we have three bank that time. So Bank of Bengal, Bank of Bombay, Bank of Madras. Bank of Calcutta was established on 1806. This 1806 established on 1806 in Calcutta. Okay, so which were later on it was we can say it was merged with Bank of Bengal. So we only have these three numbers. Okay, so 3 years later the name that was changed to Bank of Bengal on 2nd of January 1809. Okay, so previously it was known as Bank of Calcutta. Then it was renamed as Bank of Bengal. So Bank of Bengal was established in 1809. Previously it was known as Bank of Calcutta, and later on it was defined as the Presidency Bank in India. So this is the history of Presidency Bank. Later on we merged all these three Presidency Bank and we created Imperial Bank. Okay, so the Imperial Bank of India came into existence on 27th of January 1921. The three Presidency Bank, these were Bank of Bengal, Bank of Bombay, and Bank of Madras. So we merged all these three entities and we created Imperial Bank of India in 1921. Okay, so like this, with this flow you can remember the overall history. Like first bank was Bank of Hindustan, then we talk about Awadh Commercial Bank 1881, then Punjab National Bank 1894, then we have these three Presidency Bank, then we merged all three Presidency Bank and we created Imperial Bank. Okay, so after this particular thing, we after the independence, we generally or we means RBI that generally take over the Imperial Bank, and it is they generally renamed Imperial Bank as State Bank of India in 1955. So this after, if you talk about the second phase, which is also known as nationalization phase, So if you see the category, sometimes it is pre-independence and post-independence, or even like there are some authors or economists, those who generally categorize banking system in among three parts, which is pre-independence, second one is nationalization phase, and till 90, and after 90s it is modern phase. Okay, so don't get confused. So now if you talk about the post-independence or the second era, or so we have the major bank was established during this particular period was State Bank of India and Associate, and the nationalization of banking system was take place. Okay, so State Bank of India was established on 1st of July 1955, where basically RBI, who generally took take over the Imperial Bank, and they generally renamed it as a State Bank of India. So okay, and we passed State Bank of India Act 1955. Okay, so in 1959, eight associates or subsidiaries was created for State Bank of India. Now, if you see the history, so again it start with the Bank of Hindustan, then Awadh, then Punjab National Bank, then three Presidency Bank, then Imperial Bank. Now your Imperial Bank become State Bank of India. So State Bank of India, like in 1955 when we created a State Bank of India, it is one of the largest bank that time as well. Okay, so we have this one bank that time, but if you see the overall geography of India, we are the seventh largest economy in the world as per the geographical areas, or even by population wise. So it was very hard to manage all or to cater the banking services to all Indian with one bank. So that's why in 1959 the State Bank of India Subsidiary Act was passed by Government of India. Okay, so we created eight different subsidiaries as per the requirement of Indian economy. Like previously we have this one bank, State Bank of India, so which were generally providing services to all Indians. Okay, banking services to all Indians. Now, like you can imagine that particular situation, it was very hard. That time we do not have technology and all, so it was very hard to provide or to cater banking services to all Indians. So now we passed this State Bank of India Subsidiary Act 1959, and we created subsidiaries in different locations. Okay, like in Punjab, State Bank of Patiala; for Madhya Pradesh, State Bank of Indore; for Rajasthan, Bikaner and Jaipur. So Travancore. So we have different. We created these particular different associates. Okay, so these were the associates of State Bank of India. So Bikaner, Jaipur, Saurashtra, Indore, Hyderabad, Patiala, Mysore, and Travancore. So if you'll see the Indian map or geographical map of India, so you'll find कि with the help of these particular associate or subsidiaries, we are trying to create financial inclusion in Indian economy, or we are basically trying to cater the banking services to all Indians with the help of these particular associate. Okay. Then later on we start merging these particular associates as the technology start growing, or we have more banks in the economy, so we start merging all these associate and subsidiaries with State Bank of India. Okay, so in 1959 State Bank of Hyderabad become the first subsidiary of State Bank of India, and these were the eight subsidiaries that time. Okay, so the merger of associate bank of State Bank of India start from here. So in 1963, State Bank of Bikaner and Jaipur. So previously we have these two banks in Rajasthan only. So now we merge State Bank of Bikaner and Jaipur. So previously we have State Bank of Bikaner, State Bank of Jaipur. So now we merge these two entities and we created SBBJ, which is known as State Bank of Bikaner and Jaipur. Okay, so first merger happened here. Then State Bank of Saurashtra, that generally merged with State Bank of India in 2008. In 2010, State Bank of Indore merged with State Bank of India. So now we have only that time till 2017, we have these five subsidiaries of or five associate of State Bank of India. So in 2017, Government of India, they generally merge all associate of State Bank of India in State Bank of India. Okay, so like Hyderabad, Patiala, Mysore, Travancore, Bikaner and Jaipur, so these all are generally merged with State Bank of India. So now we do not have any associate for State Bank of India. So now basically government, like today if you study the technology in Indian banking system, so that become very advanced. So now we can manage the banking services, or we can cater the banking services to all Indian with the help of one bank, or like we have a CBS system, core banking solutions. We have this online banking, digital banking, so it is very easy to maintain, to manage the overall crowd. Okay, so later on, we generally in 2017 we merged all the seven associate of State Bank of India with SBI. Okay, so this was the history of the merger of State Bank of India, or the other one as well. Now nationalization. So during the second phase, the nationalization that generally take place, and that's why this particular time is generally known as nationalization phase as well, because government of India, like if you study Indian economy during 1960s or 70s, so that time the services was limited to a few areas, okay, to metro cities and all. So government, with the objective of financial inclusion, the then Indira Gandhi government, they generally take a step, or that step was overnight. So they generally list out the top 14 banks in India and they nationalize them. So nationalization means they change the ownership from private to public. So previously these 14 banks were generally managed by private entities. So now the ownership transferred to the government of India. And like the difference between private and public is, private entities, they are generally revenue oriented, they are generally business oriented, so they are generally catering their services in metro cities only. Okay, so now after this ownership changed, so basically government of India, now these banks belong to government of India, so government of India belongs to the general public, so they start opening their branches in rural areas or other remote areas as well. Okay, so that's why this was the first nationalization was happened in 1969. So we have two major nationalization dates where we generally nationalize bank in bulk. Like first one was 1969 where 14 banks were nationalized, and second one was 1980 where 6 banks were nationalized. So nationalization meaning, I hope you understood this one. So basically the ownership is changed from private to public. Okay, so two major phases. First one is 1969 or 19th of July 1969, 14 major bank of India were nationalized, and that time the minimum capital requirement was 50 crores. Okay, and the objective was same as I earlier told you. It was financial inclusion or to expand the banking business across the country. So these were the 14 major banks which were nationalized during first phase of nationalization. Okay, these are like Central Bank of India, Bank of India, Punjab National Bank, Bank of Baroda, United Commercial Bank, Canara Bank, Dena Bank, United Bank, Syndicate Bank, Allahabad Bank, Indian Bank, Union Bank of India, Bank of Maharashtra, and Indian Overseas Bank. So you do not need to remember the list of these particular banks. This is just for an idea. Okay, so you just go through these particular one. You do not need to remember which bank is nationalized in first phase or second phase. Okay, so this is just for an idea. Okay, second phase was happened in 1980, so or as on 15th of April 1980. Now this time, if you study the politics in India or the political background of Indian economy, so Congress government the first time lose election in 1978. Okay, after the emergency situation, and the Janata Dal government, they generally came into government, but their government is last for 2 years only. So in 1980 again Congress government they win the election. So when they come with their development agendas, so they generally did this nationalization for the second time. So 6 major bank after apart from those 14 banks, so 14 plus 6. Okay, so 6 major bank were nationalized, and this time the capital was 200 crore and above. Okay, so nowadays, like for a commercial bank, like for State Bank of India, for ICICI Bank, SDFC Bank, the minimum capital requirement is 500 crore rupees. Okay, so that time it was 200 crore rupees. Okay, so these are the six banks which were nationalized during the second phase in 1980. So Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Commerce, Punjab and Sindh Bank, and Vijaya Bank. So this way, government is they are generally trying to achieve the financial inclusion target, or they generally like now these bank belongs to government of India, and this is like we have a democracy. So here, government that generally belongs to the public, or that is generally appointed by the public. Okay, so if they'll provide services to the public, so next term of election, they'll public will generally support them. Okay, so this was the major agenda for the nationalization of banks. I hope this is clear to all of you. So apart from that, like we did this, we created number of bank, a number of public sector bank in India. Now in modern age or in modern banking, government they have a thought of one banking, one nation. Okay, so now they start like we have number of banks, so it is very hard to manage these particular bank. Okay, so if we'll have limited banks, so we can easily keep an eye on these particular bank, or even RBI as the central bank, they can manage or they can regulate these particular bank easily. But if you have number of bank, so there is a more chances of default. Okay, so on 4th of September 1993, New Bank of India was merged with Punjab National Bank. So now the number will going to decrease and it will come to 12 numbers. Okay, Syndicate Bank was merged with Canara Bank in 2020. In 2020, Oriental Bank of Commerce and United Bank of India merged with Punjab National Bank. Okay, and Allahabad Bank merged with Indian Bank. So we are now decreasing the numbers. Okay, then in 2020 again, Andhra Bank and Corporation Bank they merged with Union Bank of India, and again 2020 Vijaya Bank and Dena Bank they generally merged with Bank of Baroda. So as of now we have 11 nationalized bank and one is State Bank of India. So we have 12 public sector banks in India as of now. Okay, so I hope you're getting these particular things. So previously, like that time in 1969, the requirement or the economic requirement was totally different. Now we have total different requirement. Okay, so that time we are very poor in term of technology, or that time we do not have this particular thing, or even with the investors or the customers they do not have the awareness about the technology and all. But nowadays we do have that awareness, we do have these digital tools and all, so that's why government they are generally decreasing these particular numbers. Okay, so this is the overall list, or even government they also have the further idea to merge these particular banks and they reduce the number till 6. Okay, so I hope you get the basic history of Indian banking system. Now we'll come to the functions of bank. Okay, so what are the basic functions which is generally performed by banks? I hope you as of now like so many times you heard about the banking operation and businesses, and you have a basic idea about the banking functions. So the primary function is that remains same. It is borrowing for the purpose of lending. Okay, so borrowing and lending. Borrowing for the purpose of lending, this is the primary function of bank. They borrow money in the term of in the form of term and demand liabilities, and they lend that particular money in the form of loans. So apart from this, there are so many other activities like cross selling, or the locker facilities, checkbook facilities, or the guarantor facilities. So there are so many activities which is generally performed by banks. Okay, so primary functions and secondary function. So primary function is accepting deposit in the form of CASA and RAFA, current account and saving account. Okay, and recurring deposit account and fixed deposit account. Okay, so demand deposit and term deposit, and granting loan in so loan and advances, so car loan, home loan, education, personal, business. So this is the primary function of bank. And secondary function, agency work. So they do agency work, they sell the product of third parties, insurance companies, mutual fund companies, share broking companies and all. And utility functions like they provide you locker facility, or the other services. Okay, checkbook facility and all, so they generally comes under secondary function. Okay, so primary functions, if you talk about the primary functions of bank, so they generally accept demand deposit. These are CASA deposit, current account and saving account, and term deposit. So now the difference between demand deposit and term deposit in CASA and RAFA. So we will discuss this particular thing. I already did a video on the different type of deposits which is generally handled and managed by banks. Okay, so like current account, saving, FD, RD, or NRE, NRO, FCNR, Nostro, Vostro, Loro. So all these accounts. So do watch that particular one. So that will help you to build your concept towards these particular topic. Okay. So demand deposit, as you know, CASA deposit are generally part of demand deposits. Why these are generally known as demand deposit? Because these can be demanded by customer anytime. Okay, so let's say if you have 10,000 rupees in your saving account, so whenever you require that particular money, so you can have a request for withdrawal. Okay, you buy ATM, by bank branch, or by online transaction and all. But RAFA deposit, recurring and fixed deposit account, so these are the deposit which bank hold for a fixed time duration. They do have a maturity period. Okay, so let's say you started some RD with bank for 5 years, for 10 years. You deposit in FD for 10 years. So that is the basic difference. So that's why CASA deposit are also known as demand deposit, and RAFA deposit is generally known as term deposit. So you can go through this one. So these receipts are payable on demand by the customers. So current account and saving account are example of demand deposit. So term deposit, these deposits are repayable on maturity dates. So we do have that pre-maturity case. Like if you have a question like key in RD or in FD, we have pre-maturity benefit. Yes, you do have that particular benefit, but that also take time. Let's say if you have a fixed deposit with any XYZ bank in India, if you want, let's say that particular one is for 10 years, if you want that particular money in 7 years, so you can premature your FD, but it will take some processing time. Generally, Indian bank, they generally ask for 7 working days. Okay, so that is not given by banks on demand, okay, on customer demands. But in case of current account and saving account, that is generally provided by the banks on customer demands. Okay, so here you can see the difference of saving account and current account. I already did a video on this particular one, so quickly go through this particular chart so you'll get an idea. Okay, so first one we have interest rate. So current account is generally for business purpose is business, and here it is individual or personal. Okay, so in case of current account, bank do not offer any rate of interest. Here they offer you some rate of interest. Suitability, it is for business person, it is for income, like it is for individual, or it is a part of retail product. Okay, restrictions, there is no restrictions of number of transactions because bank is not offering you any rate of interest, so there is no restrictions on the transactions type, like you can do number of transactions in a day. Okay, so because that is a requirement of, these are generally mean to requirement of bank business. Okay, so to fulfill the requirement of business. Okay, here these are for individuals, so we do have some restrictions, like in your bank, let's say if you have saving account with any bank, so they generally imply some restrictions on you, like you can withdraw 4 times in a month from ATMs. After that it will be chargeable, or the deposit and other things. Okay, facility, current account holder enjoy overdraft facility. So there is a benefit of overdraft in current account, but in case of saving account, there is no overdraft facilities provided. In case of BSBDA, or now it is generally known as Pradhan Mantri Jan Dhan Yojana. So don't get confused with this particular one. So in Pradhan Mantri Jan Dhan Yojana, you will get an overdraft facility of 10,000 if your account is operational from last 6 months. Okay, but it is a government sponsor scheme, it is not your saving account. In basically in saving account, there is no overdraft facilities provided by banks. So do remember this. If examiner asks you, is there any overdraft facility on saving account, so your answer will be no. Okay, and in case of current account, it is yes. Operation by check, so both you can like in case of current account as well as saving account, you can use checkbooks for payments and all. Another one is recurring deposit and fixed deposit account. So RD and FD, they also known as term deposit. So duration, RD is minimum for 6 months, maximum for 10 years. FD is minimum for 7 days, maximum for 10 years. Okay, So if you talk about the amount, so it is minimum 1200 rupees, 100 rupees per month it can be, okay. So 1200 rupees per annum, okay. So minimum denomination of investment is 100 rupees, and here there is no limit, so you can start with minimum 5000 and maximum it can be any amount, okay. So here basically sometimes bank they generally impose some restriction, like you cannot open the RD more than 15 lakhs. So that totally depend on the investors or the customer's credit cycle or his overall net worth. Okay, when to deposit amount, so it is every month's quarterly. So these are recurring in nature, means like when you start RD, so it is recurring. So the recurring cycle can be like monthly, quarterly, half yearly, yearly. Okay, so it is one time investment in case of fixed deposit. When you start FD, so it is one time deposit. Okay, and rate of interest, if you compare with fixed deposit, so the RD rate of interest are lower than your fixed deposit. Okay, so these are the CASA and RAFA deposit, or demand deposit and fixed deposit, okay, or term deposit. Now the other part, loans are generally provided by banks. So loans are basically part of credit, or these are the generally assets of bank, okay. So as borrowing, like CASA and RAFA, they are generally liability product for the bank. Loans are the asset product of the bank. So because banks, they generally get interest, they generally earn interest on these particular deposit. So I hope you heard that particular term, non-performing asset. So if any loan or any borrowers who generally borrow money from banks and they won't be able to repay that particular money, so they are generally classified as non-performing asset, because that assets is not gaining anything from the investments, okay. So that's why they generally known as non-performing assets, okay, NPA. So loan is the amount of money that individual or companies borrow from bank or financial institution to manage financially planned or unplanned expenses, okay. So components of loan is like principal. Let's say you took 10 lakh rupees education loan from bank, so this is your principal, and throughout this loan is generally for 10 years, so this is your 10 years, so 10 years, and during these 10 years the interest was 3 lakh, so this is your interest, okay. So bank, they generally charge some certain rate of interest on these kind of borrowings or loans. So that is, so these are the components, and these are very simple, you understand these particular thing. So loans are categorized among two part. One is secured loan. Secured loans means, let's say you took a home loan. Home loan is generally part of secured loan, okay. So let's say you you take a loan of 50 lakh from any XYZ bank. So against this we have a collateral, okay. So that collateral or that security is the document of that particular house, okay. So these are secured loan. If in case of any kind of default, bank will sell this particular house and they'll retain their money. So that is, these loan are generally known as secured loan. So in case of secured loan, the rate of interest will be at lower side, okay. If you see, home loan rate of interest as of now, it is around 8% in India. But if you go for the personal loan, it is 13%, 14% and all. So the reason is, here we do have less risk, here we have high risk. So you know the risk and return payoff. Lower the risk, lower the return; higher the risk, higher the return, okay. So secured loan are those loans where basically the borrowers who generally pledge a collateral with the bank, okay. Pledge, hypothecation, mortgage, these are different type of securities which is generally deposited by borrowers with the bank, okay. So in case of any default, bank can sell that particular assets or that particular security and they can retain their money. But in case of unsecured loan, there is no collateral or no demand, no security is deposited by the borrowers, okay. So like we have an example of personal loan. Personal loan, so these are the highly risky loans, okay. So let's say there is a person, Mr. X, who took a personal loan of 5 lakh rupees from any bank. So there is no collateral against this particular loan. So if anything happened with this Mr. X, let's say after 2 years, Mr. X met with an accident and he got died. That so the bank will bear the entire 5 lakh rupees loss or whatever the remaining outstanding balance for this particular loan. So bank, they have to bear that particular loss. Okay. So here we have high risk. So the return or the rate of interest will be also at higher side. Okay. So I hope you remember that risk and return payoff. I already taught you in previous videos. Okay. So these two. Apart from this, now that there is one another term that is known as advances. So sometimes student, they got confused between loan and advances. So loan is generally for long term prospect. Okay. So this borrowing is generally for long term, which means more than 1 years. Okay. So let's say for 1 year, 2 years, 10 years, 15 years, 30 years. So that is a part of loan. It can be for less than 1 year as well, but in this way we generally have this one. The another difference is, in case of loan, the repayment is generally done in the form in the term of EMI, equated monthly installment. Okay, so in case of loan, the money is written in the form of EMIs. Okay, equated monthly installment. But in case of advances, they are generally for short term, and the written the borrower, they generally return that particular money in one go or in one installment. Okay, so advances, okay, this is the next one. So advances, they are generally for short term. Funds provided by bank to any entity or a specific purpose or be repayable after a short duration is known as advances. So we have overdraft, we have cash credit. So we have two major type of advances. So overdraft is, let's say you have current account with any bank. Okay, so as per your business transaction, company allow you 1 crore rupees overdraft facility. So let's say if in your bank there is 10 crore rupees and you have to make a payment of 11 crore rupees. So you can use this 10 crore plus 1 crore overdraft facility of bank. So you can make that particular payments. Okay, so that is overdraft. But this amount is generally payable after a certain time duration. Usually it is 45 days. So after 45 days, you have to pay this particular amount. Otherwise, bank will make some penalties. Okay. So overdraft facility by the bank, in which the customer can withdraw money from his account or up to a specific limit. Okay. So they can use, let's say they need 10.5 crore rupees. So they can use 50 lakh rupees from this 1 crore rupees limit. Okay. Cash credit, a facility granted by a bank in which the customer can advance money up to a certain limit against asset pledge. So they have to manage, like in case of advances, you do not need any collateral or security or pledge, but in case of cash credit, you need, like let's say you have some FD with that particular bank. So against that particular FD, you can take a benefit of cash credit. Okay, hope you get this particular thing clearly. So secondary functions of bank. So these were the primary function of bank. Now secondary functions of banks are like agency work. So transfer of funds, they generally help you in transfer of money from one account to another, like NEFT, RTGS and all these facilities. Periodic payment of loans and other things or credit cards. Check collections or other functions like credit card payments and all of these particular one. Okay. Utility functions like locker facility. The bank, they generally provide you locker facility. Social welfare programs are done by banks. Underwriting of shares, like if any company is coming with their IPO, so bank, they also provide the underwriting facility. Underwriting is basically, let's say, as per the SEBI guidelines, if you are coming with an IPO, so there should be a minimum 90% subscription for that particular IPO. Let's say this IPO size is 100 crore rupees, so there should be a minimum 90 crore rupees bidding for this particular IPO. Otherwise, this IPO will got cancelled. So in this particular case, nowadays we have bank. They generally work as an underwriter. So bank, they generally tie up with this particular XYZ company. They said, if there is any shortfall in this purchase, so they'll buy the remaining one. Let's say in this XYZ company's IPO, they subscribe 85% only. So remaining 5% will be the bank will buy remaining 5%. So that is underwriting or underwriting of shares in case of an IPO. Okay. So other functions which is generally performed by the banks, or like so many functions nowadays, like agent, mutual third party services, cross selling. So these are generally part of your secondary functions as well. Okay, so hope you get these particular thing clearly. Now next thing is types of bank. So if you study Indian banking system, so we have number of banks. Okay, so we have different types of bank. Like first one, the market regulator, that is also known as the central bank. So the central bank is RBI, Reserve Bank of India, so which generally manage or regulate Indian banking system. So if you study types of bank in India, so it is one type. So it is a bank who generally mean to regulate, supervise or govern Indian banking system. Then we have a commercial bank. So commercial banks. So commercial banks further categorized into two parts, like scheduled and non-scheduled. Scheduled banks, which generally comes under second schedule of RBI Act 1934, those who generally follow the guidelines under second schedule of RBI, and non-scheduled, those who do not follow that particular one. Okay, we have RRBs, regional rural banks. Commercial banks, further classification is public sector banks, private sector banks, or foreign banks, or even now we have payment banks, small finance banks. So these all generally comes under this one. Okay, we have RRBs, regional rural banks. We have development banks. Okay, development banks. So we have number of type of we have so many types of banks in Indian economy. We will discuss these particular one. So with this particular chart, you will get an idea about the banks in India. So first one is central bank, the central bank basically. So the central bank. So it is RBI who generally manage regulate Indian banking system. We have commercial bank. So commercial bank, scheduled and non-scheduled. Scheduled, those generally comes in the second schedule of RBI Act 1934. So if you will study the second schedule of RBI Act 1934, there are certain guidelines like towards the minimum capital requirement, towards the board of members and all. So if any bank who generally fulfill these guidelines, they generally comes in the scheduled banks. Okay, or maximum bank, we have scheduled banks in India. Okay, so further classification is public sector bank, which are generally governed by government of India, or more than 50% ownership belongs to the government of India, public sector banks. Private sector banks, where basically maximum ownership belongs to individual or private entities. Foreign banks are those banks which is generally, if you see these particular banks, their headquarter and registration that is in some other country, they are operating banking business in Indian economy, like HSBC, Citibank and all. Okay, regional rural banks, these are banks which came into existence in 1975 with some specific objective, or their key areas are rural areas. Okay, apart from this, we have cooperative banks, so urban cooperative banks, rural cooperative banks. We have development banks, okay, like NABARD and all. So we have specialized banks, so which generally like Paytm, payment bank, small finance bank. They are also part of commercial bank nowadays. Okay, so basically they generally fulfill the guidelines of. They are even like most of bank. They generally become part of scheduled commercial bank as well. Okay, so regional rural banks, if you study the history of regional rural banks, because like why I directly coming to regional rural banks, because RBI we have a separate unit, so where we'll discuss RBI in detail, or for these different banks we already discussed these particular one. Okay, so that's why I'm coming to RRBs, because like if we'll not cover RRB here, it will remaining. Okay, it will left out. Okay, so the regional rural banks was set up on the recommendation of Narsimham Committee 1975 by the legislation of RRBs Act 1976. So they are created with a mandate to provide essential basic banking financial services to rural areas, or you can say if you study the PSL guidelines, priority sector norms for RRBs, so they have to lend 75% of their net annual credit to the priority sector. And what comes under priority sector? It comes like agriculture, small scale industries, housing infrastructure, or renewable energy, or weaker section. So they're generally part of this one. So when Narsimham Committee they presented their reports. So they generally design these particular bank as per the requirements of rural India. Okay, so agriculture and allied base or the other small scales. Okay, so first RRB in India was Prathama Gramin Bank. So Prathama Gramin Bank was the first RRB in India, and it was established in 1975. It was sponsored by Syndicate Bank. Okay, so it was established in Muradabad district. Whenever you see the overall ownership in any RRB, so we have three owners in RRBs. First one is central government by 50%. So RRBs owned by central government by 50%, and state government, if you see the ownership of state government, it is 15%, and the third one is sponsored bank, it is remaining 35%. So in any RRB, when you will see their ownership, so we have three owner for RRBs. So central government, government of India, is generally owned by 50%, state government 15%, and sponsored by sponsored bank 35%. Who is a sponsored bank? All nationalized commercial bank in India. Okay, so now the case is, let's say, as I told you, syndicate Prathama Gramin Bank was the first Gramin bank in India. So it was sponsored by Syndicate Bank, which means 35% ownership belongs to Syndicate Bank, and it was located in Moradabad district of Uttar Pradesh. So 15% to Uttar Pradesh government and remaining 50% to central government. Okay, so hope you get this particular thing clearly. Apart from this, we have Development Bank as well. So four major development, and one of the largest is NABARD, National Bank for Agriculture and Rural Development. So if you see these development bank, they generally work toward the key. They have they have a specific purpose. Like for NABARD, it is agriculture and rural development. For EXIM, it is export credit, or to help to give monetary benefit to export houses. For NHB, National Housing Bank, it is basically the housing or the infrastructure or housing development in India. For SIDB, it is MSME and all. Okay, so we created these four development banks, which is like they have a certain target, or they have a specific areas where they have to lend the money. Okay, so NABARD was established on 12th of July 1982, headquartered based in Mumbai, and the key specific area is agriculture and rural development. SIDB was established in 1990, or on 2nd of April 1990. Headquarter is located in Lucknow, and the key focus area is MSME. So here we have agriculture and rural development. Okay, agriculture plus allied activities plus rural development. Okay, and NHB, National Housing Bank. So the focus area was housing development. It was established in 1988, headquartered based in New Delhi. EXIM, Export Import Banks. So it generally facilitated to export houses. 1982, Mumbai. So if you differentiate the commercial bank and development bank. So development bank, there is three major areas. First, they have a key development area. Like for NABARD, it is agriculture and rural development. For EXIM, it is export import credit. Okay. Second one is they do not accept deposit from the customers. Okay, so like you cannot open your saving account with NABARD or NHB or EXIM, because they generally work as an intermediary. Okay, so the government of India, they generally provide funds to NABARD, and NABARD will circulate that particular money to the farmers with the help of RRBs or other commercial bank. Okay, so agriculture or farmers, they cannot directly connect with NABARD. So we do have some intermediaries between these two entities. Okay, and third one is they deals in lending part only. So they do not borrow money from the public. Okay, so the money is generally provided by Government of India or RBI through different schemes or budgetary allocations. So they lend that particular money with the help of intermediaries. Okay, so hope you get this one. Now in latest time duration in 2015, RBI gave license to two new banking businesses in India. So one was small finance bank and another one was payment bank. So the objective was financial inclusion. So the primary objective of payment bank as well as small finance bank was to achieve this financial inclusion, okay, across the country. So that time we have there are a number of finance companies which were generally working toward in different areas or in small cities. So their fate was limited to a specific state or some specific district and all. So now RBI that generally gave them license as a small finance bank. So now they have a trust at the country level. Okay, so small finance bank to help or to promote the small businesses or the agriculture rural areas and all. It was the recommendation committee behind the small finance bank was Usha Thurat ma'am, and the initial capital was 200 the initial capital is 200 crore rupees and more. Previously in 2015 it was 100 crore rupees, so now it is increased to 200 crore rupees. Okay, AU Small Finance Bank was the first small finance bank. No, this is the wrong one actually. So, Capital Local Area Bank was the first small finance bank in India. Okay, so do remember this one. Capital Small Finance Bank was the first small finance bank in India. So, AU is an example of small finance bank, but the first small finance bank was the Capital Local Area Bank based in Jalandhar, Punjab. Okay, next one, Payment Bank. So again, the license was given in 2015 only, and these were established on the recommendation of Nachiket More Committee. Okay, and the objective was to create financial inclusion in Indian economy. Okay, so initial requirement is 100 crore rupees. So this is like if you talk about the payment bank and small finance bank. So I already did a video on payment bank and small finance bank, or the differences or the number of banks and all. So I'll very soon I'll upload that particular video so you can watch for detailed one. Okay, so because we need a specific knowledge toward payment and small finance bank, because these are generally part of latest banking, even including digital banking unit. So I'll come with a detailed video based on payment, small and digital banking unit, so that will help you in your upcoming examination. Okay, so guys, here in this particular session, hey guys, welcome back. So hope you all are doing well. So in this particular video, we will talk about the Reserve Bank of India. So RBI, which generally work as the central bank for Indian economy. So being a central bank, there are so many role and responsibilities which are generally maintained by RBI. So we will discuss these things about in this particular video. Okay, so this after this particular video, you'll know all about RBI. So like we will talk about the basic history of RBI, board of directors, major functions of RBI, subsidiaries of RBI, departments of RBI and all. Okay. So the only request to all of you guys, please do like and share this video so other can also watch. And if you are new to my channel, please do subscribe. Right. So guys, whenever we talk about RBI, it is generally known as the central bank. Okay. So in every country we have a central bank. Okay. Like in US it is Federal Reserve Bank. In China it is People's Bank of China. In Japan it is Bank of Japan. So similarly in India as well, it is the function of central bank that is generally performed by RBI. And being a central bank, there are so many role and responsibilities which is generally performed by Reserve Bank of India. Okay. So like it manages the overall banking system in the economy, not only banking, even the other financial activities like money management or the liquidity management, currency printing, regulation and supervision of banks and all. So many time I hope you heard about these particular functions. So today we will deep dive the effects, the structure of RBI, or the everything about the Reserve Bank of India. Okay, so we will start with the basic one. Like I hope you know, RBI was established on 1st of April 1935 under RBI Act 1934. So who was the recommendation committee for the establishment of Reserve Bank of India? So the answer is Hilton Young Commission. Okay, so these are some important facts related to RBI. Today my marker is not working, so I highlight these particular one. So RBI was established on 1st of April 1935 under RBI Act, Reserve Bank of India Act 1934. Okay, so it was established on the recommendation of Hilton Young Commission, which was founded in 1926. Okay, so initially RBI headquarters was located in Kolkata, the then Calcutta. In 1937, it was permanently shifted to Mumbai. So, so many times examiner asked this particular question. Okay, so in 1937, RBI headquarters was permanently shifted to Mumbai. Along with the headquarters, RBI have four local board offices, regional offices, and 29 regional offices. Okay, four local board plus 29 regional offices. Okay. It was the initial capital of RBI was 5 crore rupees, and this 5 crore divided by 10 each year, and so 5 lakh shares, and all these shares belongs to Government of India. Okay, so the initial capital of state Reserve Bank of India was 5 crore rupees, and the 5 crore divided by 10, face value of per share was 10 rupees. So total number is 5 lakh, and all these 5 lakh shares belongs to Government of India. If you talk about the nationalization of RBI, so it happens in 1949 or on 1st of January 1949 under the Reserve Bank of India Transfer of Public Ownership Act 1948. Please do remember this one. Sometimes students they got confused with the Banking Regulation Act 1949, and they generally think that RBI was nationalized under BR Act 1949, but it was nationalized under RBI, the Transfer of Public Ownership Act 1948, with a minimum capital of or initial capital of 5 crore rupees. Okay, so these are some basic facts which you need to know about the introduction part, being a central bank. So these are the basic things about Reserve Bank of India. Okay, so apart from this, I'll show you a table. So where you will see the important dates or years related to RBI. Okay, so here you can see 4th of August 1926, Hilton Young Commission was formed, or Hilton Young Commission, who generally represented their report towards RBI, and on the recommendations of this, RBI Act 1934 was passed on 5th of March 1934. Okay, so Reserve Bank of India Act passed, which provide a statutory basis to basis the function, the bank functioning, or the Reserve Bank of India's day-to-day activities. Okay, so RBI that generally works under or as per the Reserve Bank of India Act 1934. Okay, and it was passed on 5th of March 1934. 1st of April 1935, finally their date came, and the Reserve Bank of India was established, being a central bank. And first time, if you talk about the first governor of RBI, so that time when we created RBI as a central bank on the 1st of April 1935, so the governor of RBI was Sir Osborne Smith. So Sir Osborne Smith was the first governor of Reserve Bank of India. Okay, so and first Indian governor was C.D. Deshmukh. He was the third governor of RBI basically. But if you talk about the first Indian governor, it is C.D. Deshmukh. But first governor was Sir Osborne Smith. Okay, on 1st of April 1947. So previously, before independence, RBI that generally provides central banking services to two other countries. One was Myanmar and another one was Pakistan. So banking function in Burma, now Myanmar, ceased with the termination of Part 2 of the Burma Monetary Agreement. So RBI prior 1st April 1947, RBI used to provide central banking services to Burma or Myanmar. So we seized that particular one. On 30th of June 1948, so previously we also, or RBI also provide banking services to Pakistan, central banking services to Pakistan. So it was also seized on this particular date. Okay, 1st of January 1949, RBI was nationalized under RBI Transfer of Public Ownership Act 1948, and first 16 March 1949 statutory liquidity ratio, that is known as SLR. So SLR was introduced on 16th of March 1949. Okay, so it's a reserve ratio which generally bank have to maintain with itself. Okay, in the form of cash, gold, and government securities. We already discussed this one in our monetary policy unit. So these are some important dates and years about Reserve Bank of India. or the RBI history. Okay, some other fact as well. So as I earlier told you, CD Deshmukh was the first Indian governor of RBI. As earlier mentioned, Osborne Smith was the first governor of RBI. First Indian governor was CD Deshmukh. He was the third governor of RBI. RBI was also the central bank for Myanmar and Pakistan, and we seized these particular one in 1947 for Myanmar and 1948 for Pakistan. Manmohan Singh is the only prime minister to have also served as governor of RBI, Reserve Bank of India. He was also finance minister or prime minister, and he is the only finance minister, prime minister who also served the post of RBI governor. Okay, so hope these particular facts are clear. Now, if you talk about the powers of RBI, so there are two major acts which generally provide RBI powers, or the functioning of RBI is generally based on these two acts. One is RBI Act 1934, another one is Banking Regulation Act 1949. Okay, so it generally provide RBI supervision and control over commercial banks, and along with this licensing and establishment of banks. Okay, so if let's say if you want to start banking business in India, so you have to file your application with the Reserve Bank of India. Okay, so RBI that generally provides certain guidelines. If you fulfill that particular guidelines, those guidelines, so you will be able to start banking business in India. Okay, so branch expansion, if any bank, existing bank who want to expand their branches, so RBI will give license. Liquidity of their assets. Okay, how you have to maintain your liquid asset in your organizations. Management and method of working, so day-to-day working of banks. Amalgamation and mergers of banks or branches. Reconstruction and liquidations of assets. These are some major functions or major powers which is generally given to RBI as per RBI Act 1934 and Banking Regulation Act 1949. So when we'll come to the functions of RBI, we will deep dive these particular one. Okay, first we will discuss the overall structure of the RBI or the central bank. Then we'll come to the these points or the working areas and all. Okay, next point is offices of RBI. So as I earlier told you, so RBI headquarters is located in Mumbai, and it was permanently shifted to Mumbai in 1937. Earlier it was in Calcutta. Now it is known as Kolkata. Okay, so when we started RBI in 1935, Calcutta was the major business hub. So the RBI headquarters was that time located in Calcutta. Now in 1937, it was permanently shifted to Mumbai. So now headquarters is located in Mumbai. So the central office is basically where RBI governor, the office of RBI governor, as well as the board of directors that generally belongs to RBI, and they formulate policies about Indian banking system or towards the bank. Okay. Along with headquarters, RBI have four zonal offices. Okay, or local board offices. They also known as local board offices. They generally belongs to these metropolitan cities. Okay, so whenever we talk about metropolitan cities in India, so these are the four major cities: Delhi, Mumbai, Kolkata, and Chennai. So along with the RBI head office, RBI have four local board offices or zonal offices. These are located in Delhi, Mumbai, Kolkata, and Chennai. And we have 27 regional offices and 4 sub offices for these regional offices. Okay, so sub offices are also known as divisional offices. So RBI apart from head office or 4 local board offices, 27 regional offices and sub offices. The total number is 31. Okay, so most of regional offices are in the state capital, like for Uttarakhand it is located in Dehradun, or for Uttar Pradesh we have in Lucknow, or sub office in Kanpur. So this way we have a number of offices of RBI. Okay, State Bank of India act as an agent of RBI state where RBI does not have its offices. So this is very important point. Okay, so let's say if there is any state where RBI do not have their own offices, so State Bank of India will work as an agent for RBI in that particular state. Okay, so hope this is clear. So if you see the reporting and order in reporting things, So order is generally passed by the central office or the headquarter of RBI, which is located in Mumbai. So RBI Mumbai office will pass on this particular order to four local board offices: Delhi, Mumbai, Kolkata, Chennai. Then these local board offices will pass on that particular order to 27 regional and sub offices. Okay, if you talk of regional and sub offices will pass on that particular order to banks. Okay, so now these banks role is reporting. So bank will report to regional office to local board office to head office. So this way the entire working of RBI is generally defined. Okay, and along with these particular offices, RBI have number of departments. So nowadays it is 30 departments. Okay, if you'll visit the RBI website, you will find there are 30 departments of RBI which generally help RBI to perform their role and responsibilities. Because like if you see Indian economy, so we are a large economy. We are seven largest in term of geographical area. So we have number of banks and financial institution in the system. So to properly manage these one or to achieve the end goal of RBI, so RBI created number of departments. So these numbers are 30. So here we will discuss about some important departments like Department of Currency Management, which generally works toward the issuance or the management of currency in Indian economy. Payment and Settlement, I hope you remember that PSS Act 2007, Payment and Settlement System Act 2007. NPCA is major organization under this one. Okay, Financial Inclusion and Development Department. We have Foreign Exchange Department. We have Monetary Policy Department. So these are out of 30. These are the topmost departments, which has the key roles in Indian economy or towards the banking system of India. Okay, first one is Currency Management Department. So it generally work the management of currency note design, the currency note design, printing, timely supply of currency notes, and withdrawal of currency note and distribution of coins. Okay, coins are generally designed and manufactured by Government of India. So we have four different coin minting places in India. Okay, but currency note, everything related to note like their design, printing, or the overall supply management is generally done by Reserve Bank of India under this is generally done by a Department of Currency Management under RBI. Okay, and even the distribution of coins is also done by RBI. So we have different currency chests in India. So with the help of these currency chests, RBI that generally manage or circulate the currency system in India. Okay, Department of Payment and Settlement System. So it is a separate department of RBI which generally founded in March 2005. It generally take care about the online digital payments things in India. Like NPCI is major entity which generally work as an umbrella organization for retail payment and settlement in India. Okay, it is a separate entity. It is registered under Companies Act 2013, but it generally help. Okay, this department that generally provide guidelines for NPCI as well. Okay, so policy formulation in respect to payment and settlement. Authorization of payment and settlement system and operators. Let's say if you willing to start some payment tools in India like UPI, Phone Pay and all. So this department will give you the license. Okay, regulation of payment and settlement system in India, supervision and monitoring of payment and settlement in India. So that is generally these retail payment system or settlements in India is generally taken care by Department of Payment and Settlement System in India. Next one, we have Financial Inclusion and Development Departments, which generally do the research and development in Indian economy about finance or about the financial inclusion, or it generally study the development of the required development in different areas, how the financial inclusion is really working. So these things are generally taken care by this particular one. So to formulate micro policy to strengthen credit flow to the priority sectors like agriculture, small scale industries, weaker section, renewable energy, or those 8 sectors. Okay, to ensure that priority sector lending become a tool for the bank to capture untapped business opportunities among the financially excluded section of the society. So that PSL norms is again the generally part of or the proper implementations of PSL guidelines is generally comes under Financial Inclusion and Development Department. Okay. Next one we have Forex Department, Foreign Exchange Department. So Foreign Exchange Regulation Act 1973. Now it is generally known as FEMA Act 1999, Foreign Exchange Management Act 1999. So it generally take care about the overall guidelines related to forex business in India. Okay, and it generally comes under forex or foreign exchange department under RBI. Okay, so the objective is to smoothen the overall forex transaction in Indian economy, to give license to entities as authorized dealer. So like if you have to exchange your currency in some foreign currencies, so you can easily do that. Okay, and even to provide guidelines toward these authorized dealers, how they'll work and all, and to protect the interest of consumers, those who generally dealing in forex market. Okay, next one we have Monetary Policy Department. I hope you heard about this so many times. Like they generally meet on bi-monthly basis, or they come with the current liquidity status in Indian economy, or they generally manage the overall liquidity in Indian economy, we can say. Okay, with targeting the price stability, or to control inflation, growth in Indian economy, to create employments and all. Okay, so MPC, Monetary Policy Committee, assists the MPC in formulation of monetary policy, and it provide technical input to the MPC, such as short-term and long-term inflation projection. So it basically provide the data towards the overall liquidity in Indian economy, the current inflation rates, and how what is the expectations in the future, and the current growth prospect of Indian economy. So these all data is generally provided by department, the monetary department of RBI, and which generally assists to monetary policy committee, which is a team of 6 members, including RBI governor. Okay, so these are the major departments of RBI, which, like as I told you, the role and responsibilities of RBI are like, we have so many responsibilities which is generally performed by RBI. And if you study the demographic of India, so we have like we are the 7th largest economy in the world, or we have 2nd largest population size in the world. So to cater all part of India, we need different departments, those who working in different areas. Okay, so we have 30 departments as of now of RBI, those generally assist RBI to perform well, or to achieve their end goal or mission and vision. Okay, now we'll talk about the Central Board of Directors. Okay, or it is also known as Team RBI. So Central Board of Directors, there are number of members which are generally part of Central Board of Directors. Okay, so these are like RBI governor, we have 4 deputy governors, 4 member from local board offices, 10 member from Ministry, Government of India, okay, 2 member from Ministry of Finance. So this way we created a team who generally help RBI to make decisions. Okay, Reserve Bank of India is governed by the Central Board of Directors. So the entire things or the decision making is generally governed by the by this particular board only. Okay, and the board is appointed by Government of India, keeping with the Reserve Bank of India Act 1934, appointed and nominated for a period of 4 years. Okay, so the board is the Central Board of RBI, or the Central Board of Directors, that generally govern RBI workings in India. So, and it is work under RBI Act 1934, and appointed as per the RBI Act 1934, and it is appointed by Government of India for 4 years. Governor and deputy governors are appointed under Section 8 1A of the RBI Act 1934. So sometime examiner, they generally test these particular sections as well. So that's why I keep these one. Official director, full-time directors, if you talk about. So we have governor and not more than 4 deputy governors. So 1 governor and 4 deputy governors. So at a time you'll find maximum 4 deputy governor of RBI. Sometime, like due to some retirement and all, it is 3, you'll find 3 or 2, but it is not more than 4. Okay, non-official, 10 member from Government of India. They are generally nominated from different fields. It is include the corporate houses or the private corporate houses as well. Okay, 4 director from local board offices. So we have 4 local board offices of RBI: Delhi, Mumbai, Kolkata, and Chennai. So most of the time their head is generally part of team RBI. Okay, two member from Ministry of Finance. So this way we have all these like 4 5 5 plus 10 15 plus 4 19 or 2 21. So our team RBI is a we can say it is a 21 member team which generally take decisions about RBI's working, or even sometimes they come with they come with some new solution regarding the latest problems. Okay, so as of now, if you talk about the team RBI's major pillars, so RBI Governor Sri Saktikant Das and four deputy governors. So these are the four deputy governors: Mahesh Kumar Jain, Michael Devrat Patra, M. Rajeshwar Rao, and T. Ravi Shankar. So M.K. Jain and Michael Devatra, they generally reappointed last year for next 3 years. Okay, so they are generally like RBI governor is generally appointed for a maximum period of 3 years. Then after that, we generally go for reappointment. Similarly for the deputy governors as well. Okay, so this is the overall board of RBI, which generally help RBI to make right decisions about the Indian banking system. Now, along with this department teams and all, so RBI they have some subsidiaries as well. So what is subsidiary? It is part of RBI. The decision, or they are generally owned by RBI, and these are like the maximum ownership in these organizations are generally belongs to Reserve Bank of India, but they are a separate entity. So to deal with the different areas, RBI have created as of now we have four subsidiaries of RBI. Previously we have fifth one, that was NHB, National Housing Bank, which was later on it was it is generally taken care by it is taken by Government of India. So it is a National Housing Bank, and 24th of April 2019 it was taken over by Government of India. So now it belongs to Government of India, and these four are generally belongs to RBI. So we have four major subsidiaries of RBI. One is DICGC, Deposit Insurance and Credit Guarantee Corporation. I hope you heard about this one so many times. Okay, it generally provide deposit insurance, or it generally provide insurance to our deposit with banks. Okay, Bharatiya Reserve Bank Note Mudran Private Limited, which generally works toward the currency printing or the overall management of currency. Okay, Reserve Bank of India IT, Information Technology. So all IT related solutions is generally provided by Reserve Bank of India Information Technology Private Limited. Financial in Indian Financial Technology and Allied Services, IFTAS, that generally provide the communications related to banking business in India. Okay, so we will go through these one by one. So first one is DICGC. It was founded on 15th of July 1978 under DICGC Act 1961. Okay, so do remember this act as well. So many times examiner they generally ask question based on act as well. Headquarter is located in Mumbai, and chairman, if you talk about the chairman of all subsidiaries, so most of the time you'll find the deputy governor of RBI, they generally own these they generally had these subsidiaries. Okay, so deputy governor of RBI currently Michael Devrat Patra, who generally lead the DICGC, and current insurance limit is rupees 5 lakh. Okay, so let's say if you have a deposit with any XYZ bank, and that bank, let's say you have 3 lakh rupees in that particular bank, okay, in your saving account, and 50,000 is overall interest from last 10 years, 15 years. Okay, so the total principal and interest is 3,50,000. Okay, so if that particular bank become defaulter, so you can approach DICGC, and DICGC will provide you that remaining that principal plus interest, which is 3.5 lakh rupees as your deposit protector. Okay, so the maximum limit is 5 lakh rupees. Okay, so let's say if in your account there is 7 lakh rupees, so DICGC will pay you only 5 lakh rupees. If 50,000, they'll pay you only 50,000. Okay, it include principal as well as interest, but the maximum limit is only rupees 5 lakh. Okay, so it generally work under DICGC Act 1961, and it is established for providing insurance of deposit and guaranteeing the credit facility. Okay, so like there are so many times there are number of banks who become defaulter. So in that particular case, the ICGC that generally is trying to protect the small depositors in Indian economy. Okay. Next one we have Bharatiya Reserve Bank Note Mudran Private Limited. It is like as the name state. So Note Mudran Private Limited. So Note Mudran means where we generally print currencies. Okay. So it was established on 3rd of February 1995. The headquarters of BRB and MPL is located in Bengaluru, and it has two presses. Okay, one is Mysuru, another one is Salboni. So if you talk about the total currency printing presses in India, so we have four presses. Okay, these are located in Devas, Nasik, Mysuru and Salboni. But Devas and Nasik printing press are generally owned by Government of India, and Mysuru and Salboni, Mysuru in Karnataka, Salboni in West Bengal, these are generally owned by Government of RBI under Bharatiya Reserve Bank Note Mudran Private Limited. So you can go through this one as well. So we have four printing presses in India. So one is Nasik, another one is Devas. So Nasik and Devas one is generally owned by Government of India. And Mysuru and Salboni, these are generally owned by RBI under Bharatiya Reserve Bank Note Mudran Private Limited. Okay. So two of currency printing press are owned by Government of India and two is by Reserve Bank of India. So these are generally owned by RBI. Government of India own these particular one. So as we earlier discussed this particular data. So do remember these names. So all four names as well as their ownership belongs to. Okay. So if we talk about the currency printing thing in India, so these are some important facts related to currency printing. So Nasik and Devas are owned by Government of India under Section 22 of Banking RBI Act 1934. Reserve Bank of India is solely responsible for managing currency note except rupees 1. So rupees currency note rupees 2 and above is generally printed and minted by RBI Reserve Bank of India. Okay, and currency rupees note 1 is generally printed by Government of India under Ministry of Finance or Ministry of Finance under Government of India. This data is again very important one. So the highest denomination of currency note in India is rupees 10,000 as per section 22 of RBI Act 1934. Okay, so as per section 22 of RBI Act 1934, the maximum denomination of currency note can be rupees 20,000. Like as of now we have 2,000 rupees. It can be, or RBI can print up to 10,000. Okay. So Reserve Bank of India was 10,000. In 1938, demonetized this one. Okay, like we have three time demonetization. 1946, we demonetized 10,000 rupees currency note. In 1966, RBI that generally demonetized rupees 1,000, 5,000 or 10,000 currency note. In 2016, RBI demonetized rupees 500 and 1,000 currency note. Okay, so if the examiner asks you the maximum denomination, so your answer will be 10,000. In case of coin, it is 1,000 rupees. Okay, so rupees 10,000 was again introduced in 1954 and it was demonetized in 1978, not in 1966. Okay, so we have three time demonetization. One is 1946, another one is 1978, and third one or the latest one is 2016 as well. Okay, so maximum currency denomination currency denomination can be 10,000 or for coin it is 1,000. Next subsidiary is IFTAS. So Indian Financial Technology and Allied Services. It was founded in 2016 and headquarters is located in Mumbai. So to manage and operate the financial messaging system in India. Okay, let's say we have SWIFT. SWIFT is Society for Worldwide Interbank Financial Telecommunication. I hope you heard about this particular one. So it generally manages messaging thing across the world. Okay, so let's say if you do some remittances from US, so your account got debited and credited, this thing is generally managed by SWIFT. But in India, let's say you withdraw 5,000 rupees from your account, instantly you get a message your account has been debited by 5,000 rupees. So this message or this messaging thing is generally managed by IFTAS in India. Okay, so if you talk about this one, so NEFT, RTGS, and other things or payment settlement networks. So these are infinite. That entire infinite system is generally managed by IFTAs in India. Okay. Next one we have Reserve Bank of India Information Technology. So information, all IT related assistance is generally provided by IFTA, Reserve Bank of India Information Technology Private Limited. Okay, it was established in 2016 and headquarter is located in Navi Mumbai. Okay, so objective is to take care IT requirements including cyber security need of RBI. So it generally manages cyber security, research and innovation, technology related, system audit and project management of RBI. So these are some major functions which is generally performed by RBIT, or that is generally known as Reserve Bank of India Technology Private Limited. Okay, I hope we get this particular thing as well. Now we'll talk about functions of RBI. This is very simple one. Okay, so many time I hope you read about the functions of RBI. So it will help you in your written examination as well as in interview. So these functions should be on your fingertips. Like whenever we talk about functions of RBI, so being a central bank, there are so many functions which is generally performed by RBI, like supervision and monitoring of banks, regulation of financial system or banks, currency printing, KYC regulation, bankers to the bank, bankers to the government of India, lenders of the last reserve, custodian of exchange, forex management. So there are so many functions which are generally performed by RBI being a central bank. So here we will discuss some important one, or still if you have any problem with any area you can mention in comment section. Okay, but these functions are the most important and you have to remember these functions. Like during interview, that interviewer they generally ask, tell me the 5 functions of RBI. So this way you can run your interview. Okay, so if you remember the top 5, so let's say you mention issuer of currency. Okay, so now the cross question is will based on the whatever point you pick. Okay, so issuance of currency or monetary policy regulation, then interviewer will ask question based on whatever you deliver. Okay, so you need a clarity about these particular things. Okay, so main functions of RBI is to formulate monetary policy. So monetary policy regulation or formulation is generally done by Reserve Bank of India with the help of MPC, Monetary Policy Committee, and with the help of monetary policy, RBI that generally manages liquidity in the Indian economy, often targeting the inflation rate or the price stability in Indian economy and economic growth, and as well as a lower unemployment rate. Okay, so we already did a video on monetary policy. I hope you remember. Regulate and supervise the financial system. So to provide guidelines to find the loopholes in system and to repair them. So this is the role and responsibility of RBI. Manage Indian forex market. So forex market is again taken care by RBI as per FEMA Act, Foreign Exchange Management Act 1999. Issuance of currency. So the currency management or the overall supply of money in Indian economy is again managed by RBI. So printing of currency and all these things. Bankers to the bank. If any bank need any kind of assistance like loan or other things, so that is generally provided by RBI. So like we have repo rate, we have MSF. We read about we read about open market not open market operation, repo rate, reverse repo rate, or SDF. So these are generally tools. Bankers to the government of India, like open market operation. So when government of India need any financial requirement, so that is also fulfilled by RBI. Development role in the economy. So RBI also fulfill the development requirements of Indian economy. So as per the requirement, they generally come up with the new schemes. Okay, regulate and supervise the payment and settlement system in India or the payment related entities. So apart from that, exchange management we already discussed, supervisory, regulation of banking system and KYC regulation. So guidelines related to KYC that generally comes under section 35A of banking regulation act 1949. So the regulated entities or the key things related, like if any customer is interacting with Indian banking system, so these are the basic requirements, and these requirements are generally set by Reserve Bank of India, and timely manner they generally revise these particular guidelines as well. Okay, currency we already discussed this particular thing. So currency, if you talk about the rupees 1 note and number of coins, so these are generally belongs to the authority, generally belongs to Government of India, Ministry of Finance under Government of India, and rupees 2 note and above are printed by RBI. Okay, and if you talk about the signatory authority, in case of rupee 1 you will find the finance secretary, in case of rupees 2 and above you will find RBI governor. Okay, and the maximum denomination for currency note is 10,000 rupees, and for coin it is 1,000 rupees. Coin are generally minted as per Coinage Act 2011. Okay, previously it was 2010, and currency note are generally printed as per RBI Act 1934 section 22. Okay, so these are the important things related to currency which generally examiner ask in your examination. Okay, and the currency printing method we use, that is known as minimum reserve ratio. So minimum reserve ratio is generally used to identify the need of new currency in Indian economy, or even it will also help you to judge the overall supply of money in Indian economy. So whenever RBI, they generally print or issue new currencies, they generally make some reserve. Okay, that is generally known as minimum reserve ratio. So it is 200 crore rupees reserve, 135 is to 85. Okay. Next one is 120 is to 80. Okay. Next one is major act which are generally administered by RBI. So these are the act which generally work with RBI. Okay, so Reserve Bank of India Act 1934, or RBI, we can say RBI work accordance to these particular one. Public Debt Act 1980, 1944. Now it is known as Government Securities Act 2006. Government Securities Regulation Act 2007. Banking Regulation Act 1949. FEMA, Foreign Exchange Management Act 1999, SARFAESI Act 2002, Securitization and Reconstruction of Financial Asset, and Enforcement of Security Interest. Okay, and Credit Information Companies Regulation Act 2005, and we have Payment and Settlement System Act 2007. So these acts are again administered by RBI, and like if any changes happen with these particular one, so that is again done by Board of Directors of RBI. Okay, so even they generally propose that particular changes, right? So guys, in this Hey guys, welcome back. So in this particular video, we are going to talk about monetary policy. So monetary policy, as you know, it is administered by RBI, or the central bank, and through this particular policy, the central bank or RBI, they generally manage the liquidity in the Indian economy. So this is one of the most important functions which is performed by RBI. So whenever you study the functions of RBI or the major functions of RBI, so monetary policy is one of those. Okay, so again, if you talk about the examination viewpoint, so this is one of the most important topic for your examinations from economics or banking awareness section. Okay, so here in this particular video today, we are going to talk about the basic introduction of monetary policy. What is monetary policy? How does it work and all? Then we'll talk about the process of monetary policy. And then we have monetary policy committee, which is a decision making committee about monetary policy. So we have 6 members for this particular one, which is known as MPC. Then we have monetary policy instrument. We have quantitative tools as well as qualitative tool. So we'll talk about quantitative as well as qualitative tools. Then we have type of monetary policy as well, right? So if you study newspaper and current related things, so the RBI or the Monetary Policy Committee, they generally come with quarterly meetings, okay, or bi-monthly meetings. In every 2 months, there is a meet of this MPC. It is mandatory to conduct 4 times in a year, but if you see last 2 years, so in every 2 years, in every 2 months, they generally conduct this particular meetings, right? So what are like during that meeting is very, very important for all of you. Like sometimes they change the rates, or sometimes they come with some new policies and all. So you have to go through those particular one before your examination. Let's say your examination is scheduled in August month. So before the first meet is April, then there is a gap in May, then June, then August. So let's say there is some changes in June month monetary policy meet. So you have to take care about these particular changes as well, right? So today we are going to talk about monetary policy, and I'll try to make these particular thing very I'll try to explain in very simple language so you can easily get these particular thing, right? So whenever we talk about monetary policy, first thing you guys need to remember, so this is basically administered by the central bank, and in India it is managed by RBI. So monetary policy is basically function of RBI. So we have two policies. One is fiscal policy, another one is monetary policy. Fiscal policy, that is administered by government of India, and monetary policy, that is managed by RBI. So what is the meaning of monetary policy? So through monetary policy, RBI or the central bank that generally control liquidity. So liquidity means supply of money. Whenever we talk about liquidity, it means supply of money. So through this particular policy, RBI that generally manage liquidity in the market. Now what are the goal of this particular policy? So to create a win-win situation between growth and inflation, right? So growth and inflation, to create a balance between growth and inflation situation, right? So I hope you guys understand, if there is a excess liquidity in the market, so if there is a high liquidity in the market, so there is a problem of inflation, right? So if you'll have more money, you will spend more, so the prices will goes up. So first thing, if there will be higher liquidity in the market, there will be a problem of inflation. If there is a less liquidity in the market, so if businessmen, they'll not have money in their hand for new projects, so the overall productivity of economy will goes down. Okay, if you will not have money, so you will make less demand. So there is a less demand, which means the overall productivity of that particular economy will goes down. So liquidity, we have to create liquidity at a certain level, and that things is generally done by RBI through monetary policy. So if you see the process, so monetary policy is the process through which RBI or the central bank that generally manage liquidity. Liquidity means supply of money, often targeting, we have targets like inflation, to maintain growth, or if there will be growth, there will be employment, right? So if you define monetary policy, now it become very simple. So monetary policy is the process through which RBI or the central bank that generally manage liquidity in the market, and they generally try to achieve that particular goal. They can manage the proper balance between growth and inflation level. So we need an inflation. I hope you guys remember our last video. So the suitable range of inflation as per RBI or as per the monetary policy committee is 2 to 6% or 4% plus to minus 2. Okay, so this level is generally managed by RBI through this particular one. And growth is like the overall growth of economy, which is very necessary for being a developing nation. We have to achieve so many targets. So we have some priorities. To achieve that one, we need money. So there is a balance between growth and inflation, and that is created by monetary policy. So if you define this particular one, now you get now you'll easily get this particular definition. So as with previous chart, we go through these particular concepts. So monetary policy is the process by which the monetary authority, which is RBI in India, control liquidity, often targeting inflation rate. The primary target is inflation, then growth, then employment. Why I am saying primary target is inflation? Because if you study fiscal policy, so if you see the target of fiscal policy, the major target is growth, because fiscal policy is generally run by government of India, and we have election system. So politicians, they have to show some growth in 5 years, right? So they are always growth oriented. And first fiscal policy came, we have budgetary system, so that generally published on 1st of February for next financial year. So first they announced schemes, they announced the allocation of resources, the allocation of expenditure for the upcoming year. Then monetary policy with bi-monthly policy, they generally try to manage the inflation level in the economy as well. So hope this is clear to each and everyone. Now, before coming to the monetary policy instrument, how RBI manage liquidity by using different tools. So there is a decision making committee which is generally known as MPC, Monetary Policy Committee. So previously means before this particular date, before 2016, this decision is generally made by, there is a board of RBI, so they generally come together, they generally do voting and all. So that process was quite big. So in 2016 we came up with a proper team of 6 members, that is generally known as Monetary Policy Committee. So it is introduced under the Finance Act 2016, and the right are given under RBI Act 1934. So there are 6 members in Monetary Policy Committee. 3 members, they are generally represent to RBI, including governor, and 3 members are from Government of India. Okay. So 3 members from RBI, 3 members from Government of India, and this is generally headed by RBI governor. Okay, if examiner asks who lead this particular team, so your answer will be RBI governor. Or even like every 2 months we have this particular meeting. So if there is a case of tie vote, like in every 2 months these 6 member or this MPC meet. So they generally discuss the current situation of inflation, the current growth situation, or you can say they generally analyze the current liquidity status in the market. So if after their discussion they generally do voting. So if in any case there is a tie vote, 3 people are saying there is a need of liquidity in the market, but 3 people are saying there is no need of further liquidity, we should maintain a status quo, right? So in that particular situation, RBI governor, they have a dual vote right? So if RBI governor is saying we need to increase liquidity, so that decision will go in the favor of RBI team. If they are saying we should decrease liquidity or we should maintain the same level, again the decision will go with RBI governor only, right? So this meet is generally handled bi-monthly nowadays. If you study from last 2-3 years, in every 2 months they generally conduct this particular meeting. But if you see the procedure, if you see the legals, so there should be like this meeting should be at least 4 times in a year. If examiner asks like how many times this meeting should be conducted by MPC team, so your answer will be at least for 4 times. It can be more than 4 times as well, right? Monetary scale. Now what is monetary scale? Whenever you analyze the current monetary policy announcements, so whenever they made any changes, let's say they increase repo rate, let's say they increase repo rate from 6.25 percentage to 6.50%. Okay, so if you'll see the announcement, they'll say कि repo rate is increased by 25 basis points. So basis point is we generally use this basis point for the measurement. Like for the measurement of this marker, we'll use millimeter, centimeter, inches. We use kilograms and the other things. We have different measures. Similarly here as well. So 1% is equal to 100 basis point. So they increase repo rate by 25.25%, 6.25 to 6.50, which means they increase repo rate by 25 basis point. If let's say they increase repo rate by 0.50%, so you will see they'll say the repo rate is increased by 50 basis point. Okay. So this is just for your understanding. So Monetary Policy Committee, which is basically decision making committee on monetary policy in India, right? So it came into existence from April 1st, 2016. Usually they conduct meetings on bi-monthly basis. So hope this is clear to each and everyone. Still guys, if you face any problem with any point, please feel free to reach. Okay. Now if you talk about the monetary policy, so we have 2 type of monetary policy. As these names state, one is quantitative in nature and another one is qualitative. So we have 2 type of monetary policy basically, or the entire working of monetary policy is divided into 2 parts. One is quantitative changes or quantitative methods, another one is qualitative. Now what is the difference between quantitative and qualitative? So whenever we talk about the quantitative, so it means we are talking about numbers. So there is a changes in certain numbers. Let's say they increase repo rate by
25 basis points. So what will be the impact of 25 basis point in on the liquidity, that is pre-decided. If they increase the CRR by 50 basis point, so what will be the impact of this 50 basis point on the liquidity, that is already defined, okay, because that is something related to numbers. But qualitative is like when some other things, some other decision made by MPC during their meet, okay, so they came with some like they change the margin for loaning, they change something, they come with some new guidelines. So that is generally part of your qualitative, right? So we will start with quantitative tools first, then we'll come to qualitative tools as well, right? So guys, whenever we talk about the quantitative tool, as I earlier told you, so it is something related to numbers, okay. For every tool you will have some number, some certain number, like if RBI is changing CRR by this percentage, so this will be the effect on liquidity on the market. So this is the basic crux of your quantitative tools, okay. So we have number of tools. These tools are further divided into two parts. One is direct, another one is indirect. Direct tools, we have CRR, cash reserve ratio, and SLR. Now what is difference between direct and indirect? So direct means they have a direct impact on the liquidity. Let's say RBI, when you will discuss these particular tool in detail, you'll easily get that particular one, okay. So let's say the current CRR is 4.25%, suppose that. So RBI increase it to 4.50%. Now this 25 basis point changes equal to, suppose that, 50,000 crore, okay. So here the 50,000 crore from, like, RBI will observe 50,000 crore rupees from the market. So there will be 50,000 crore less liquidity in the market. There is no other way, right? So that is a direct impact. But in case of indirect, let's say if you talk about repo rate, so let's say the repo rate is, previous one was 6.25%, and RBI, they generally change it to 6.50%, suppose that, okay. So now repo rate is RBI to commercial bank. So that loan which commercial bank was earlier getting at the rate of 6.25, now they are getting at 6.50%. So if bank are getting the loan from RBI at a higher rate, so they'll also offer loan to customer at a higher rate of interest. So definitely they are going to increase the lending rate or the loan rate for the customers. But in this case of indirect, it is a time taking process, okay. As RBI increase, after some time bank will also start increasing their base rate, okay. Base rate is basically the rate below which bank do not lend to customers. Let's say a bank like SBI, base rate was, suppose that, 8% for home loan. Now after this changes, they also increase base rate by 8.25%, which means SBI is not going to give loan to customers below 8.25%. So that is indirect. But this decision is generally made by bank itself. So this minimum that prime benchmark lending rate is generally decided by the bank itself. So they'll definitely going to increase their rate, but when they'll increase, that is totally decided by the bank itself, okay. So hope you get these particular thing clearly. So with now next thing we are going to discuss, that is we'll talk about what is CRR, what is SLR, what is repo rate, what is TLTRO, targeted long-term repo operations, which is generally introduced by RBI during COVID situation. We have reverse repo rate, we have MSF, we have bank rate, we have term repo, we have standing deposit facility. This was introduced by RBI in 2022. Okay, this is a collateral free loan facility for the bank itself. So again, this is very important for your examination purpose. So now we will understand what is CRR, the theoretical portion. Then we'll come to how RBI used CRR to manage liquidity, right? So first tool, we have direct tool. First one is CRR, current cash reserve ratio, and another one is your statutory liquidity ratio. So CRR, the current CRR is 4.50%, And guys, one thing, like this rate is generally decided by MPC during their monetary policy meet, so it is variable. So as of January 2023, I'm recording this video in January 2023, it is 4.50. So after, like, the next meeting is scheduled for February 2023, maybe they change this particular one, maybe they increase, or maybe they decrease, or maybe they maintain the same level. That is totally depend on the liquidity status in Indian economy, right? So you have to update this particular one, or I would suggest whenever RBI come with their monetary policy meetings, so it is a must read for all of you, right? So you have to read these particular thing. And still, like, if you have, even I'll also come with some analysis of these monetary policy meet, but you should also read this particular one, so that will definitely going to help you. Okay, so what is CRR? CRR is cash reserve ratio. How you will understand, how you will remember this one? So I hope you understand this particular term, that is NDTL. So a portion of their NDTL that a bank must maintain with RBI in cash. So every bank, NDTL is net demand and time liabilities, which is, like, you can say, like whenever bank do credit creation in the market, so there is a certain amount that bank hold. Let's say a bank who have 100 crore rupees of NDTL. So there is a XYZ bank who have 100 crore rupees NDTL. So out of this 100 crore rupees, so which means they have 100 crore rupees in their hand for lending. Okay, so every bank, they have to maintain NDTL. So let's say the NDTL of any XYZ bank is 100 crore rupees. So out of this 100 crore rupees, they have to deposit a certain percentage of CRR, which is maintained in the form of cash, and that is maintained with RBI. So every bank, every commercial bank in India, whatever their NDTL is, they have to maintain a certain percentage. CRR means, like, current it is 4.5%. So out of this 100 crore rupees, they have to maintain 4.5 crore rupees with RBI. So they have to deposit this money with RBI in the form of cash. And RBI will not give any rate of interest on this particular rate of on this particular lending. So suppose that SBI current NDTL is 100 crore rupees. So out of this 100 crore rupees, they have to deposit 4.5 crore rupees, or they have to maintain 4.5 crore rupees with RBI. They have to deposit this money with RBI in the form of cash, and RBI will not pay any rate of interest on this one. So RBI does not pay any interest on the CRR. So this is, you can just understand this thing as a rule one. How RBI use this particular one, I'll explain after the SLR. So just remember the tool. Okay? So suppose that there is a bank whose NDTL average, this is generally maintained on fortnight basis. Like bank, they have to report it on fortnight basis, which means every 14 days. So whatever their NDTL, they have to deposit some amount with RBI in the form of cash, right? Now next one is SLR, statutory liquidity ratio. So again, a portion of NDTL. So let's say same bank SBI, their NDTL is 100 crore rupees. So now they have to deposit a certain, they have to maintain. So here they have to maintain. In previous case, they have to deposit with RBI, but in the case of statutory liquidity ratio, they have to maintain with itself. Please do remember these particular point. Okay? So they have to maintain a certain percentage of NDTL. Certain percentage means whatever the current CRR, current SLR. So in case of CRR, they have to deposit in the form of cash, but here they have to maintain in the form of, they have alternatives, like they have cash, they have gold, they have government securities, right? So let's say our same example, the NDTL is 100 crore rupees. So out of this 100 crore rupees, they have to maintain 18 crore rupees with itself. They have to maintain this amount with itself in the form of gold, or they can maintain in the form of cash, they can maintain in the form of government securities. So this is like CRR with RBI and SLR with itself. Now if you see this particular calculation, okay, now what is basically what outcome of this particular one, I'll let you know. Okay, just I'll just erase this data. Okay, hope this is visible. I'll hide myself for a while. So guys, see, now you have two tool. First one is CRR, that is 4% that bank have to maintain, 4.5% that bank have to maintain with deposit with RBI. Another one is SLR, that which is 18%. So the bank have to maintain this one. So if you'll add, so it is 22.50%, right? Now from here you'll understand the basic working of banking. So bank, if you talk about the definition of bank, which is the meaning of bank is borrowing for the purpose of lending. So they generally borrow money from those who have excess money, and they lend that particular money to those who require that particular one, right? So the borrowing and lending is the primary function of bank. So the rule 1 or 2 says, if a bank borrow 100 rupees from the market, okay, let's say there is a bank who borrow 100 rupee in the form of Kasarapa, which is NDTL for this particular bank. So out of this they have to deposit, or they have to maintain 22.50 percentage or rupees in the form of CRR and SLR. They cannot lend this particular money, right? So now the remaining one is like 77.50 rupees they can lend to the customers. So this is the current liquidity status in Indian market. So which means if a bank who borrow 100 rupees from the public, so out of this 100 rupees they have to maintain, or they have to deposit 4%, 4.5% they have to deposit with RBI. So 4.5 rupees they'll give to RBI in the form of cash, and 18% they'll maintain in the form of cash, gold and government securities. So 100 minus 22.50, so now they have 77.50 in their hand to lending. So they can give this particular money to customers in the form of loans, right? It can be car loan, it can be education loan, home loan, or any other one, right? So this is the current liquidity status in Indian economy. Hope we get this particular thing clearly. Still, if you have any doubt, please do mention in comment section, right? So now the exercises, if you see this particular one, you will get more clarity. So quantitative tool is CRR, and current CRR is 4.50%, right? And current SLR is 18%. Now try to solve these particular one. So RBI action, if RBI will increase, I'll also add the liquidity column here. So liquidity, please do understand this particular thing so you'll get more clarity. So if RBI increase CRR, if RBI increase CRR, the current CRR is 4.5%. Suppose that RBI increase it to 5%. So what will be, if RBI, now previously bank they have to deposit, I'll give you the clear case. So now suppose that after this increment it become 5%. So previously bank have to deposit only, out of 100 rupees they have to deposit 4.5 rupees with RBI. Now they have to deposit 5 rupees. So which means there is a less liquidity in the market. So now they have to deposit more money with RBI, right? Similarly, vice versa, if you come, if RBI decrease it to 4%, let's say RBI decrease it to 4%. So now they have to deposit only 4 rupees to RBI. Previously it was 4.50%, right? So there will be more liquidity in the hand of bank. So they'll have more money to lend customer. They have 50 paisa more to lend to the customers. So now hope this is clear. So if RBI increase, so there will be less liquidity. Now if there is a less liquidity in the market, so what will be the impact on inflation? Inflation will also goes down, right? So if there is a less liquidity in the market, so we'll have less demand. So if there is a less demand, the inflation will also goes down. And vice versa, if the RBI increase the liquidity, so now we'll have more money in the market, so the prices of goods and services will increase, which means there will be more inflation in the economy, right? Similarly for SLR, so the current SLR is 18%. Suppose that RBI increase it to 19%. So now they have to maintain more money, so there will be less liquidity, inflation will decrease. And if RBI decreases to 17%, so there is a more money in bank, so they have more money to lend, so the inflation will increase. So now what type of question you may face? RBI may, like examiner may ask simple question, what is CRR, what is current rate of CRR, or the other thing, or even like nowadays, the most of time they generally ask question based on this table. So they'll give you one cases. If RBI increase, like in last bi-monthly policy, RBI increased CRR by 25 basis point. So what will be the effect on liquidity? What will be the effect on inflation prices? So you have to remember this way. Okay. So hope this is clear to each and everyone. Still, guys, please feel free to ask. If you have any query, do mention in comment section. Now we'll move to the indirect instrument. What is indirect? I earlier told you. So we have a long list here, like we have repo rate, TLTRO, long-term repo operation, reverse repo rate, MSF, bank rate, MSS, open market operation, market stabilization scheme, and standard facility. Okay, so standard lending facility, we'll talk about this one. The first one, we have repo rate. Repo rate, which is also known as repurchase rate. Okay, and the current repo rate is 6.25%. I'm talking as on January 2023, and you have to maintain this particular one. You have to update yourself, right? So now what is repo rate? I'll try to explain through a chart. So repo rate is rate at which RBI lend money to commercial bank. So this is a lending rate basically. The rate at which RBI lend money to commercial bank. So the cash flow is RBI to commercial bank. Please do remember cash flows. Okay. So like I hope you guys read about RBI work as a bankers to the bank. How? So if examiner asks or if interviewer asks how RBI work as a banker to the bank. So when bank required any assistance from RBI, so that is fulfilled by RBI. Let's say if any bank required fund for short-term duration, so they can borrow money through repo rate. So this is for short-term. Short-term means here 90 days. Okay. So this is up to 90 days. So the rate at which RBI lend money to commercial bank for short term. So that rate is known as repo rate. Let's say I'll give you an example. So let's say State Bank of India, SBI, who borrow 5 crore rupees from RBI for suppose that 45 days. Okay. So if SBI is borrowing money from RBI, so RBI, like being a lender, RBI will charge some rate of interest. Okay, so that rate of interest will be your 6.25%. So per annum, these are per annum. So that rate of interest is generally known as a repo rate. How it will impact the liquidity and inflation? That is same. How it is same? So let's say if RBI increase repo rate from 6.25% to 6.50%. Okay, so now this bank will get a loan at a higher rate of interest. If he is getting higher rate of interest loan from RBI, so he'll also charge high rate of interest from customers. So like if customers are getting loan at a higher rate of interest, they'll take less loan. So there will be less liquidity in the market. So the fundamental or the concept is same. Hope this is clear. Now this tool was introduced by RBI during COVID situation 2021. Okay. So TLTRO, which is stand for targeted long-term repo operation, and you can easily understand this one. How? First one is it is targeted. Okay, T means targeted. So targeted. So we are targeting COVID-19 situation there. So that time we was targeting about COVID-19. First one, long-term means here bank they generally can take loan from RBI for 1 to 3 years. Okay. So they can take loan from RBI 1 to 3 years at repo rate. Okay, so whatever the repo rate, so like at present repo rate is 6.25%. So if RBI open this particular window, so bank will get money for long term period for 1 to 3 years at the rate of 6.25%. I hope now you're getting this particular concept clearly. So what will happen if bank are getting money at a lower rate for a higher time duration? Okay, so they'll also give loan to customer at a lower rate of interest, right? So their base rate will goes down. So now you study this particular definition. The TLTRO or LTRO is a tool under which central bank provide 1 to 3 year money to bank at a prevailing repo rate, whatever the current repo rate. Okay, accepting government securities for the collateral purpose. Let's say State Bank of India borrow 5 crore rupees from RBI for 3 years. So they have to deposit some collateral like government securities and all. Government securities means securities issued by Government of India. It can be bond or any other tool. So as bank get loan long-term funds, as bank get long-term funds at a lower rate of cost. In return, they'll reduce the rate of interest for borrowers. So LTRO help ensure that bank reduce their marginal cost of fund, that is base rate, lending rate, without reducing the policy rate. So this was the agenda of this particular tool. Hope this is clear to each and everyone. Next one, SDF. So this is newly added. This was introduced by RBI in 2020 only, and this is similar to, like, this was earlier your we can say this is similar to your reverse repo rate, but here with this particular, in reverse repo rate, the current reverse repo rate is 3.50%. Here they are getting 6%. Okay, the standing deposit facility is a collateral free liquidity observation mechanism implemented by RBI. The intention of transferring liquidity out of the commercial bank into the RBI. Let's say any commercial bank who have excess money, who have surplus money. So previously we have reverse repo rate, but the reverse repo rate interest is very low. Okay, so now let's say State Bank of India, who have 5 crore rupees excess money. So now they have two options. They can maintain that particular money with themselves itself. So they are not lending to, suppose that they are not getting any right customers. So if they are maintaining with themselves, so they have to, because this money belongs to public, so they have to pay some rate of interest to the public. Now another option is they can deposit this money to RBI and they'll get a rate of interest which is on an average or above average from from that particular bank borrow from the market. Let's say if you see the average of CASA and RAFA, that is around 4 to 5%. Now here bank is like, they deposit money and they lended this one to RBI. So RBI will settle that particular money. RBI will use that particular money, and so this is overall liquidity management for the banking system as well. Next tool we have reverse repo rate. So this is just opposite of repo rate, and the current reverse repo rate is 3.35%. So the rate is like the rate at which RBI lend money to, sorry, this reverse repo rate is the rate at which commercial bank lended their money. So the cash flow is commercial bank to RBI. So the rate at which commercial bank deposited their money with RBI or their excess money with RBI. So here let's say State Bank of India, as I gave you an example, 5 crore rupees, they have this excess money. Excess money is like they do not they don't find any customer to lend that particular one, or right customer. Okay, they have this surplus for 1 day, for 5 days, for 10 days, so they can deposit it to RBI. Okay, so RBI, so they'll charge some rate of interest, so RBI will give some rate of interest to the banks, and that rate of interest is your reverse repo rate. So now despite of this reverse repo rate, they generally go for SDF. So SDF basically promoting banks to deposit their surplus with RBI, so RBI can circulate that particular money in economy, and even they are getting high rate of interest as well. Now next one we have marginal standing facility. So if you study the marginal standing facility, it is the rate at which RBI lend money to commercial bank. Please do remember the cash flows, that is very important. So the cash flow is RBI to commercial bank for overnight. So now this tool is very like you have to deep dive to understand this particular tool. I'll try to make your understanding. So RBI to commercial bank for overnight. Overnight means 24 hours. So how it is possible? RBI lended money to bank and they return that particular money in 24 hours. No, this is a cashless transaction. First thing is, this is a cashless transaction and it is maintained through SLR securities. Okay, so now I hope you remember that point. I earlier told you CRR and SLR, so these are reserved. So every bank, they have to maintain these particular reserve on fortnight basis. In every 14 days they have to report RBI in every 14 days. So let's say there is a bank whose NDTL was 100 rupees and they lended, their maximum was they can lend 77.5, but they lended 78 rupees in the market. So first they borrow 100 rupees and they lended 78 rupees. Now the remaining 22, they have remaining 22. Out of this they have to maintain 4.50 CRR and SLR is 18%. So now they have a shortfall of 0.50%. They have a shortfall of 0.50%. So to maintain this 0.50 shortfall, because they have 100 rupees in their hand, they borrow 100 rupees, they lended 78 rupees. Now during fortnight meet, when they reporting RBI, so first they'll deposit cash 4%, 4.50% with RBI. Now their remaining amount is 17.50, but the current SLR is 18%. So they have a shortfall of 0.50%. So now to maintain that particular one, we assume, or RBI generally said, okay, for this 0.50%, I'll charge some rate of interest, which is your MSF rate, which is your current MSF rate. So first you have to maintain this one. But here the condition is, under this facility, eligible entities can avail overnight up to 3% of their respective SLR. Okay, so there is whatever their respective SLR, like if the bank entity is 500 crore, so their SLR will be different. If 5,000 crore, their SLR will be different, right? So hope you're getting this particular. So the maximum cap is they can avail up to 3% of the whatever their respective SLR portion. Okay, then let's say their SLR percentage is 500 crore. So out of 500 crore, they can use only 3% of that particular amount. Hope this is clear. Next one, bank rate. Bank rate and MSF rate are always same. So this is very simple tool. The rate at which RBI lend money to commercial bank, the cash flow is RBI to commercial bank for long term, or you can say for more than 90 days. Okay, so more than 90 days. Now the difference between repo rate and bank rate is, repo rate RBI to commercial bank for short term. If you talk about repo, so repo, it is RBI to commercial bank for short term or for 90 days, and bank is long term. Here in case of repo rate, they have to deposit collateral, but this is without collateral. Okay, so please do remember this one. Now next one, we have apart from these particular tool, we have one function that is called open market operation, which is performed by RBI, that is more closer to monetary policy. That's why I included this one. So whenever we study, RBI work as a bankers to the government of India. So how, if government of India needs some funds for short term as well as long term, so that is they asked for RBI. So RBI issues some government security on the behalf of government of India, like treasury bills. So let's say RBI issues some T-bills on behalf of government of India, where we have a government of India promised to pay this amount after this date. Okay, so RBI issue this particular one, and which means RBI sell. So after 91 days, RBI will buy this particular one, or similarly in case of bonds and all. So this buying and selling process of government securities is known as through RBI is known as your open market operation. So buying and selling of government securities through RBI is called open market operation. So here is the chart. So I hope you remember these particular one. Similarly, you can use this one for the remaining one as well. Like I'll give you an example. Let's say repo rate. So repo rate, if RBI increase repo rate, current repo rate is 6.50%. If RBI increase it to 7%, what will be happen? So there will be less liquidity in the market. So there will be less liquidity. If there is a less liquidity, so inflation rate will decrease, correct? Then if RBI decrease it to 6%, so now bank will get loan from RBI at a lower rate of interest. So there will be more liquidity in the market. So if more liquidity, the prices will goes up, or because of high demand. Okay, so this way you can use this particular concept as well. So guys, these are basically quantitative tools. Now we'll talk about qualitative tools. Qualitative tools are kind of theoretical tools. So we have four major tools under qualitative measures. So qualitative as you know, in quantitative we have certain numbers. If there is a changes, so we know the impact. But in qualitative, we are generally trying to, like, these are the decision making of RBI other than quantitatives, which also impact the liquidity in the market. Okay, how? First we have credit rationing. Okay, so limit the loan and advances. Now RBI, let's say some banks, they are facing NPA in some specific category. So RBI come with some guidelines. you cannot lend beyond this particular limit. Okay, or even like we have PSL guidelines, priority sector lending norms. So if you are if you're operating any commercial bank in India, you have to lend 40% of your ANBC to the priority sector. So now there are some limitations, okay, which also impact the liquidity in the market. So time to time RBI increase or decrease these particular one. Concessional rate of interest, let's say RBI, government of India, they're supporting made in India concept, so for startups and all. So RBI said if you are lending in agriculture, so this is the rate of interest you will charge. Okay, so that kind of moral, Susan, they can also come with some guidelines, do not cheat customers and all. They can set some policies. Changing margin requirement, let's say in case of margin, let's say for a home loan, if you are taking home loan, so you have let's say the margin is 20%. Let's say you buy a house of 1 crore rupees, so being a buyer, being a owner, you have to pay 20%. So now RBI capped this one to 25%, which means bank customers, they have to pay more money to this particular segment, or even RBI can reduce this one, so that margins for any financial product can also make an impact on the liquidity, right? Then we have some direct action like prompt corrective actions, which is PCA, prompt corrective actions or others. And then regulating consumer credits, the loan related guidelines and all. So there are so many different tools. Basically these qualitative measures are divided among 4 parts. One is credit control methods, lending related things, moral suasion, changing in margin requirements, and credit rationing. So these are the tools. They do have impact on liquidity, but they are time taking process, or even we cannot decide or we cannot define the exact the numbers about these particular tools. Okay, so one request to all of you guys, please go for the current monetary policy updates. So in every year you will find at least 4 times this policy meet, but if you see 4-5 years, so they conduct this particular meeting in every 2 years, right? So the last bi-monthly meeting that was happening in December, now next one will happen in February. Then first bi-monthly meeting for financial year 23-24 will happen in April, then June, then August. So in every 2 months you'll MPC, they generally conduct this particular meeting, and even they update these particular one. As of now, these are the current one, but after some certain meetings they may change these particular tools as per the economic requirement, or even apart from these particular instruments, they also made some announcement toward the margin requirements, toward the new product launch or the other things as well. So you have to read that particular one very carefully, and that is the most important for your examination purpose as well. So hope guys you get these particular thing clearly. Still I would say, if you have any query related to any point regarding monetary policy, so do mention in comment section. I'll try to resolve your queries. And one request to all of you guys, please do make your notes, and if you like the video, please do share with your friends, and do subscribe my channel. Okay, very soon I'll come with MCQs as well, so question based on these particular topics, which is definitely going to help you for your upcoming examination. So hope you get this particular topic clearly. Still any doubt, feel free to reach, feel free to ask. And if you have any financial topic or any economic topic which is bothering you, do mention in comment section. I'll definitely come with videos. Okay, so this is it from my side guys. Thank you for watching this video. Bye bye, take care all. Thank you.